of us at some stage of our life have dreamt of becoming rich quick. Some of us would have even thought of hatching a scam ourselves.
So today we bring you a two-part series on world's biggest scams in history. Let's see who got rich and who went to jail and how many lives were impacted in the process.
So humans can scam almost anything, which is why this two-part series is a collection of events from around the world. So watch right till the end. We even have a quiz at the end of the show. Number 10 on our countdown is the Telgi stamp paper scam of the 1990s. Abdul Karim Telgi. नाम तो सुना होगा, नहीं तो कोई बात नहीं, हम बताते हैं. This is the most cliched gangster or scamster story you're likely to come across. An honest government officer and an ambitious young son struggling in extreme poverty. The boy refuses to compromise with his circumstances and moves to a big city in search of a better life. He can't find one. He moves to another country, still can't find one. Comes back to Bombay and decides enough is enough. अब तो गुनाह का रास्ता ही अपनाना पड़ेगा and starts a small-time fake passport and illegal immigration business of sending people to the Gulf. He even makes some money to start with, but soon runs out of luck and gets arrested. These are the founding seeds of one of India's biggest scams, masterminded by Abdul Karim Telgi. Now in jail, Telgi meets his future partner in crime, Ram Ratan Soni, in 1992, and both examine multiple scam ideas and conclude that stamp paper authenticity is rarely ever checked in India. And if they can start printing and circulating fake stamp papers on a large scale, फिर तो पैसा ही पैसा. The plan was as follows. Obtain a stamp paper vending license from Maharashtra government to look like a genuine company. Telgi and Ram had secured blessings from one and all in the government. Anil Gote, a member of the Samajwadi Janata Party, makes the recommendation. Vilas Rao Deshmukh, the then revenue minister and the future chief minister of Maharashtra from the Congress party, approves it. Now the license has been obtained. They create a strong network of paper suppliers for stamp paper printing. They also buy government printing machines from the Indian security press in Nasik. Just so you know, this is where our currencies are also printed. Now with fundamental ingredients in place, they start printing counterfeit stamp papers which cannot be caught by the naked eye. They create a network of 350 plus sales staff selling cheap stamp papers to banks, insurances, stockbrokers and the general public. The pitch to companies was a 5 to 10% discount on the face value of the stamp papers. So if you are buying a 50 rupee stamp paper, Telgi will sell it to you for 45. Buyers had no reason to doubt this, since Telgi and his company were licensed by the government. But none of this revenue was actually reaching the government, since all the stamp papers were fake and were being privately printed at Telgi's local printing press. 1993 to 2003 was a total joyride, and if estimates are to be believed, the face value of his stamps and stamp papers were pegged at 30,000 crores. And his peak, he had over 123 bank accounts and operating in over 18 Indian states. So how did the joyride end and how was the scam busted? The first cracks actually appeared in 1995 when a firm named Purnanand and Company bought 16 lakhs worth of stamps from Telgi but were not issued a receipt. They contacted the General Stamp Office but discovered that these were actually not issued by the government, following which a case was filed and Telgi was even arrested. However, with his connections in the police and the government, he managed to bail out, even though this was a non-bailable offence. Cut to 2001 and the law finally caught up with him. The Karnataka police, while investigating a fraud stamp paper scam, started tapping his phone calls and ultimately found clinching grounds to arrest him. In 2002, the Pune police seized a car carrying fake stamp papers in Bandh Garden, and here too, all evidence pointed to Telgi. Nearly 3,000 crores worth of fake stamp papers were discovered from his godown in Mumbai. Despite such conclusive evidence, Telgi has a strong political influence that not only were the investigations running slow, but he continued to operate his own business even from jail. It was only in late 2003 and 2004 that Anna Hazare mobilized public support and the Bombay High Court appointed an SIT, after which the House of Cards finally started to crumble. Over 15 police officials were arrested. Among them was Inspector General of Police Sridhar Bagal, who was the first to be caught for accepting 72 lakhs from Telgi in bribes. Another shameful involvement was that of Mumbai Police Commissioner R.S. Sharma. Several other politicians were found running for cover, most notably Chhagan Bhujbal, the then Home Minister of Maharashtra. Telgi was later sentenced for 29 years in jail and a fine of over 200 crores. Telgi had multiple health problems including diabetes and AIDS, so this sentence was reduced to 13 years. But nonetheless, he passed away while serving his term in jail. Following the scam, the entire format of the Indian stamp papers were changed, such as making them state-specific and other security features including barcoding, serial numbers, special secure papers and so on. Although this was one of the biggest scandals to have ever hit India, this one is low on our countdown as the scam was short-lived and the masterminds were arrested and sentenced reasonably quickly.
Number 9 on our countdown is US subprime scam of the 2008. This is year 2001 and US economy is oozing with cash. The interests have been lowered to 1% by US Fed and more money is being pumped in by Japanese, Chinese and Middle Eastern investors. But the stock markets, after a number of tech companies had failed and crashed, people for a period lost trust in taking bets on new age tech companies which could close any time. The banks on the other hand were only turning in about 1% as returns. So there was a huge gap, and what does one do with a large sum of global and domestic money flowing in from all sides? Gold? You would think, but no, it was real estate, and for a very good reason. Between 1997 to 2001, the US house prices increased by nearly 120%, making it a clear choice way ahead of any other asset class. Now, what makes real estate an even better choice is that the investment in real estate are all against a tangible underlying asset, which has been returning mega returns. So what's the game? Now take this for an example. I want to be a homeowner and I contact a broker to help me find a house in my budget. The broker agrees and takes me around, and finally I pinpoint a property. The broker helps me connect to the potential lenders, in this case mostly banks, to secure a loan also known as a mortgage. Now since I'm a good customer, I earn well and I also have a good credit score, the banks would consider me as a worthy or a prime customer and hence my loan would be approved. I'll make the partial down payment and I'll move into my new dream house. Woohoo! All is well good till here. But this is only about me, the broker and the lender. What about the money that's flowing in from all sides? Okay. So now the investment banker goes to the bank and makes a deal, which is to turn the loan account into CDO or a collateralized debt obligation and sell it to the investors. This means the risk of non-payment is now transferred to the investment banker and the investment banker transfers it back to the investor. To further verify the quality of the investment, they are credit checked and about 75% of the assets are rated AAA, which means they are a totally safe bet to invest. Now the CDO is a tradable asset which appreciates just like any other asset based on demand and supply. And now the insurance companies pitch in and they also want a piece of the pie, so they join in to insure these and keep charging a premium. Real estate at this point in time is having a dream run. After all, there is no risk, just the premium. So net, what's happening here is that all the loans or mortgages have been sold by the lending bank to an investment bank. The EMI paid by the homeowners is going to the investment banker. They pay the bank their share and the rest is profit, and that is distributed equally between the investors and the premium paid to the insurers. Brilliant. One home loan is serving so many players, and this is how the financial markets work. But then if all is rosy, where is the problem? Now the money is still flooding and the market has in fact multiplied. It needs more investment options, but worthy or prime borrowers are limited. So what do? You turn to not so worthy borrowers or subprime borrowers and encourage them to take mortgages. Well, they gladly accept. After all, who minds living in a house they can't afford, and that too at someone else's risk? The investment banker and lending banks strike a deal. Corruption now is in full swing and all kinds of dilutions are made to the loan qualification criteria. Now these subprime assets are also credit rated and insured, say at a higher premium and a lower credit rating. The Fed increases the rates from 1% and it goes to 2 and 3 and to 4%, which means the subprime borrowers can no longer pay. The investment bankers like Lehman Brothers and so many more now have cases of default, maybe not in 1, 2s or hundreds or 1,000 but in lakhs. which means lakhs of such investments had now turned from EMIs to just physical properties. Well, no problem. We will sell these homes and recover our money. Really? But there are no buyers. Rate crash, the investments are now worth nothing, which means even the prime borrowers stop paying since the loan amount far exceeds the current value of their homes. Banks start declaring themselves bankrupt and the crisis takes over the world. Who lost how much? The scam was estimated to be over $6 trillion and more than 2 million Americans lost their job and nearly 100 million around the world were affected. Well, somebody must have become billionaire too, of course. Many of the chief executives of the banks who sold their stake in time took hundreds of millions in bonuses. And this is what you call the perfect crime. The banks who caused this crisis were the ones who got over with $200 billion from the taxpayers' money, and most of the top guys even kept their jobs. If you are beginning to get seriously interested in knowing more about this, do watch Inside Job on Amazon Prime, which is a full-length documentary.
Coming in at number 8 is the inhuman US opioid scandal. In 1980s, a new wave of healthcare was taking root in the United States. This was called hospice. Hospice is like a hospital that's giving care to the terminally ill who are effectively waiting for the eventual demise, and the hospice tries to make it as less painful as possible. One of the most popular drugs, especially for cancer patients, was called MS-Contin, made by a company named Purdue. This drug would significantly help in easing pain, allowing patients to sleep through the night. Now, since most of the patients were counting their days, the addictive nature of the pill didn't matter as long as it gave them relief. All good till here, works for the company and works for the patients. But Purdue, by this time, had got ambitious. They set their sights on the general public, which would prove to be a massive market for them, especially those who work in injury-prone areas like miners, drivers, construction workers, police, and others. So Purdue, which is owned by one of the most influential families in the world, the Sacklers, started influencing credible medical journals to start writing articles understating the addiction and claimed only 1% of the patients are likely to be addicted with this. Such articles were quoted in hundreds of medical journals, systematically cementing misinformation about the drug. With federal agencies firmly on the side of the drug maker, this drug was made available for public use. But Purdue decided to change the composition of the drug and replace the addictive morphine with another compound named oxycodone that the company claimed was much lighter. It was later found by independent studies that oxycodone was up to 35% more addictive than morphine. And even as per Purdue's own assessment, the addiction was as high as 15%. But who cares when the money is flowing in buckets? They got an army of respected doctors on their payrolls giving lectures on the benefit of the drug and downplayed all addiction risks. Commercials like I choose life, not pain was widely advertised to position OxyContin as God's blessing to humankind. The doctors across the country were so compromised that in certain states, the total opioid prescriptions were more than even the population of the entire states. So what has all of this led to? So 2 lakh Americans have lost their lives due to addiction. Data shows that every day 128 Americans die due to overdosing of opioids of different kinds. 1.7 million were found to be on substance abuse of some kind due to opioid withdrawal symptoms, of which over 6 lakh people suffer from heroin use disorder. How has life been for Purdue? Well, frankly, not too bad at all. Purdue has made over 35 billion in revenues, spent nearly 900 billion in lobbying and campaign funding. By the way, they've also been fined for 600 million. Even after all this, Purdue plans to take this drug to international markets, against which a section of US lawmakers have even filed a complaint with the WHO. In 2018, Purdue created a drug to treat the addiction that its previous drug had helped create, and is now all set to make more billions. Not one member of the Sackler family was asked to testify in any investigation. The deaths in the US due to opioid crisis is actually more than the COVID deaths so far, and the Sacklers, although now tainted, still continue to experience a comfortable and luxurious life, whereas everyday Americans struggle to keep their lives and families together.
From pharma to technology, on number 7 we have the Satyam scam of 2000s. What the F happened here? Now that's the question that was on everyone's mind when Ramalinga Raju, the CEO of Satyam Computers, turned himself in to the authorities, pleading guilty of a number of financial crimes. One of the brightest jewels of the Indian IT story, Satyam Computers, was started in 1987. At the peak of their success, Satyam was India's fourth largest IT firm, only behind TCS, Infosys and Wipro. Their clients included some of the biggest names in the world, including FIFA and the World Bank. The company was even listed on Indian and New York Stock Exchange and went to receive several awards, and revenue topped $1 billion by 2001. But like we explained in our subprime fraud case, real estate market was booming in India as well, and this is where the greed kicked in, as Raju also wanted a big pie of this boom. So by 2003 or 4, well, it's hard to be totally sure when Raju started diverting funds from Satyam reserves to his real estate company called Metas, which surprisingly reads Satyam when you read it right to left. The plan was logical, and Raju had the right political connections to make the right buys. He had the entire map of Hyderabad metro routes well in advance, so he knew where to buy. The game was to use the cash reserves and profits of a highly liquid Satyam to buy prime property around Hyderabad at steal deals. Till the time the properties appreciate, he could continue cooking up the books at Satyam, like overstating the profits, and when properties peak, he would sell them and put the money back in Satyam books. Sounds right? Well, it would have been right had Satyam's been Raju's company, but it wasn't. He had only about 10% stake in Satyam, so he had no business to move around funds of the company that was publicly owned. So now you know the core problem, let's understand the extent of the scam. Profits of Satyam Computers were inflated by over 10 times, which means a profit of 60 crores was stated as about 600 crores. As many as 300 plus shell companies were created to move the funds. Companies were created in the names of Raju's friends, family, and even some of his farm's laborer, which is right out of the Benami playbook. To substantiate the fake P&L and balance sheet, Raju printed fake bank statements, FD certificates, and created nearly 7,000 fake invoices. Whoa, that's a bit too much. He was ably advised by the global accounting firm PwC, so Satyam accounts look believable. Everything was going as per the plan, and Raju and his family had made over 2,000 crores in this process. So how did the house of cards crash? Well, come 2008, the real estate sector witnessed a massive crash, and the Satyam operations had grown so large that he could no longer just keep cooking up the books without any actual money in the bank. His entire plan of selling his properties and replenishing Satyam's coffers was massively impacted. But he was a clever man and was in no mood to give up just yet. Using his influence on the board, he passed resolution that Satyam will buy out Metas, real estate of Metas Infra, and through this he could show a transaction that will cover up the P&L shortfall without actually any money exchanging hands, as both the companies were controlled by him and his families. Solid plan. But this raised an alarm among the other shareholders, who went ahead and filed a lawsuit and stalled this move. SEBI was also now gearing up to investigate Satyam's finances. Knowing the end was near, Raju wrote a letter to his employees admitting the fraud and turned himself in to SEBI. The total extent of the scam was estimated to be nearly 8,000 crores or US $1.4 billion. The good thing, however, about this whole episode was how the government of the day stepped in to clean up the mess and save otherwise a world-class company and facilitate a smooth acquisition. This company was later bought over by Tech Mahindra, and finally it was fully integrated with the parent company. At the end of this Herculean assignment of saving Satyam, one of the chief architects of this task force, Deepak Parekh, commented, "Companies fail all over the world, but they are saved only in India."
Next up, at number 6 and last on the part 1 of this countdown, is the Punjab National Bank Nirav Modi scam. If you've been closely following all the above scams, this one is pretty lame. So much so that some of you might feel, hell, why couldn't I think of this? Well, too bad. Let's find out how this one was executed. So two companies in different countries, one buyer, one seller, trade with each other. In most cases, they wouldn't even have met. But business still goes on the basis of trust and guarantees. So who provides the guarantee? Of course, a recognized bank in both countries. So assume you're buying, say, 10 lakh masks from a company in Germany at, say, 50 rupees a mask. To pay for this, you seek a buyer's credit from a foreign bank at a lower rate of interest. The bank issuing the buyer's credit will obviously seek some sort of a guarantee by another bank where the buyer has a local account. The local bank, after validating creditworthiness and collecting necessary collateral, issues an LOU, which is also termed as a bank guarantee. Now, in case the buyer doesn't return the credit with interest, the entire liability of repayment falls on the local bank which issued the LOU. To further cover the risk, the bank deposits an amount equivalent to the LOU in a nostro account of an intermediary bank, which facilitates the entire transaction through a SWIFT protocol. The LOU, the liabilities and the SWIFT transactions are all recorded in a CBS or a central banking system. If you're in the zone, I think you can already predict where this is headed. So Nirav Modi's local Punjab National Bank was a Brady House branch in Mumbai. He approached the bank for a buyer's credit. He then colluded with some bank officials in charge of approving and processing this credit. In 2011, it began with a much smaller amount with a single letter of undertaking worth rupees 800 crores. Nirav Modi, however, didn't pay back the issuing foreign bank this loan of 800 crores and the interest thereof. But instead of raising an alarm and calling for investigation, the PNB Bank officials kept issuing more LOUs, asking the sanctioning bank to issue more loans. Like you would assume, either the bank employees doing this would have been handsomely rewarded, or they would have thought Nirav Modi was a good man and they could simply trust him with no paperwork. So what happened then? The total amount of LOUs issued now amounted to 11,000 crores. Nirav Modi's trusted bank officials had been routinely replaced by new officials. The new officials at the bank demanded a guarantee, to which Nirav Modi's company explained the process that was being followed since 2011 and demanded the LOE be issued based on the same practice. This time, however, an alarm was indeed raised. An investigation followed at PNB. A scam of epic proportions was unearthed. PNB's CBS system is not integrated with SWIFT transactions. Even the LOUs that were issued were not recorded in CBS. There was a complete breakdown of PNB audit processes, and for 7 years, no one even bothered to reconcile LOUs with balance sheets. Possibly, even the senior most teams at PNB were party to this, so they looked the other way when this was going on. So what happened finally? Nothing actually. Nirav Modi and his uncle Mehul Choksi have left the country to London, Guyana or wherever they find asylums. More additions to our existing bad loans of nearly 10 lakh crores. This routinely surfaces during elections and parliament session, and each side blames the other. All our agencies are fighting tooth and nail to get their duo back to face justice. At least that's what we're made to believe.
And before we end this show, here is the quick quiz as you wait for part 2. Question number 1. What's common among all these scams? Question number 2. What was the name of the person who Telgi met during his jail term? And finally, what do you think will be the last 5 scams that will make it to part 2 of this countdown?
Let us know in our comment section. The first 5 accurate responses will win exciting merchandise and free text, including mugs, diaries, t-shirts and so on. See you in part 2. Hope you enjoyed this episode. Thanks.
Hope you enjoyed today's episode. Please like, share, subscribe and troll us in the comment section below. We'll be back soon with episode 2 of this series. Till then, you take care, stay safe. Goodbye.